Hey, it's Jim, and this is level one of the CFA program, the topic on corporate issuers, and the learning module on capital structure. Inside of these learning modules, we have been floating around the financial statements. Most of the time, we've been on the balance sheet. Today, we're going to focus entirely on the right-hand side of the balance sheet. We'll go ahead and float over to the income statement here in the middle of this slide deck. But I want you to think about capital structure in its simplest terms. It's really just the mix of debt and equity issued by the executive leadership team of these corporations. Think about what that means. What's the goal of the business? Maximize shareholder wealth. How do executives do that? Well, they find product lines that are going to generate lots and lots of sustainable cash flows. Well, the next question is, how does the executive leadership team pay for these long-term assets? Remember I said earlier, these are hundreds of millions, oftentimes billions of dollars. So the executives have two choices. They can issue bonds or they can issue shares of stock. That's capital structure, and that's what these LOSs are telling us. Notice that second one, factors affecting capital structure. Look at the last one. Is there an optimal capital structure? Is there a target capital structure? Whenever we're talking about capital structure, what we're going to do is ask ourselves the question, how does the right-hand side of the balance sheet, the bond issue and the stock issue, how does that impact firm value? And whenever we calculate a value, and you guys know this from that very first learning module in level one, you need an interest rate. We're going to call that interest rate the weighted average cost of capital. And then my favorite LOS in there were these two dudes, 1958, Franco Modigliani and Merton Miller. These two guys essentially created the discipline of finance with their seminal paper on capital structure. If I were at the CFA Institute, I would guarantee that I would ask Modigliani and Miller questions on the exam. But then again, I say this regularly, I can never guarantee which questions are going to show up or not show up. All I can do is remind you that every LOS is a potential exam question. All right, so let's go ahead and start with that first LOS. This is a simple concept. I ask you to play roles throughout all of these recordings. Sometimes you're the shareholder, sometimes you're the bondholder, sometimes you're the wealth advisor, sometimes you're the executive leadership team. We need to combine all of those roles inside of this particular learning module. But for this first LOS, we need to play dual roles. We need to play the role of the bondholder and the shareholder. And so essentially, the executive leadership team picks up the phone and calls the bondholders and the shareholders and says, hey, can you lend us some money? We have this great wealth increasing project in which to invest. And the bondholders, they say, sure, here's our money. The shareholders say, sure, here's our money. Well, the interest rate that the bondholders and the shareholders charge the executives for providing that capital. Look at that first point there, the rate of return, the suppliers of capital. So what word did I just use? The providers of capital. This is that particular rate of return. So the bondholders and the shareholders said, sure, take our money, but you better pay us, boy, what does the Institute call it? Compensation for their capital contribution. There we go. We have two individual costs. We call these the component costs of capital. There's a cost of debt, which is mostly going to be the yield to maturity on the bond, and the cost of equity, which is mostly going to be the required rate of return on the share of stock. We'll talk at length about this. There's another dude out there, William Sharpe, among others, who developed something called the capital asset pricing model that's going to give us a really good idea of what that cost of equity is. But for this learning outcome statement and this learning module, we'll probably be given the cost of debt and the cost of equity. We'll compute those in a different learning module. A couple of quick things here. The bondholders almost always, I don't want to say always, but almost always will lend the executives their capital at a lower interest rate, at a lower cost of debt than what the shareholders will, because being a shareholder, being an owner of a company, it exposes that investor to higher risk. So remember, it's easy to think of that about it in this kind of a framework. Think of it like bondholders will provide capital for 5%, shareholders will provide capital for 15%. I mean, I'm making those numbers up, but it's a good idea. If you take the average of 5 and 15, you get around 10%, which is kind of something that you ought to have in your brain when you're approaching some of these questions. Now, if we take a weighted average of those two, let me go back here real quick. A weighted average of the cost of debt and a weighted average of the cost of equity, we get something called the weighted average cost of capital. And there in the blue box is the great old formula, weighted average cost of capital. Notice on the far right inside of each parentheses, there's the weighting of debt and the weighting of equity. Just let me give you a quick example here. If the total right-hand side of the balance sheet is 10, and there's 4 in debt and 6 in equity, then the weight of debt is 40% and the weight in equity is 60%. Now notice inside of the parentheses, excuse me, there's a cost of equity and a pre-tax cost of debt. This is what I was saying just a moment ago. We'll probably be given those numbers on the exam. And then for the debt issue, we need to multiply those two numbers by the 1 minus the tax rate, because interest expense shows up on the income statement and it lowers the tax liability. So a bond issue has a tax subsidy. It has a tax advantage that's not available to shareholders. If you look on the income statement, there's no such thing as dividend expense. Some presidents have thought about passing a law or proposing a law in which dividends are a income tax deduction, but that hasn't happened yet. All right, so what do we know about the cost of debt? When the executive leadership team issues a bond, it's making an explicit promise to the bondholders. I promise to pay interest, and I promise to return the principal. So what is this cost of debt? Look in the bottom. It can be tax deductible. Here, it is here in the United States and for many of the countries throughout the world. So it'll probably be tax deductible on the exam. And that cost of debt tends to be, what did I say earlier? It's the yield to maturity on the bond. So it tends to be forward looking, meaning that the bondholders, new bondholders, are only going to offer a price that's reflective of expectations of microeconomic conditions and macroeconomic conditions. Now, the weights in this weighted average cost of capital formula can be almost anything. They could be market value weights, they could be book value weights, and they could be expected or hoped for. We call those target weights. So what's the question, or what's the answer to the question, which of those three types of weightings is most appropriate? Well, as you can imagine, there's probably scenarios under which you would use market values, under which you would use target values, and under which you would use book values. But in general, of course, as good financial analysts, we're going to say, you know what, we don't really care what the accountants have said historically. We don't really need to know the book value. We probably want market value. Now, as good financial analysts, it's tough to discern what those target weights are going to be. Those are determined by the executive leadership team, and they're probably a little bit secretive about it. Although, if we ask the right questions at the annual meeting and during analyst calls, maybe we could get some information about those target weights. Now, what about the component cost of equity? This is the required rate of return by the equity investors. I'm going to go ahead and warn you, we're going to have great conversations about this capital asset pricing model sometime in the near future. It's almost always higher than the cost of debt, and it's not tax deductible. I said that earlier. All right, so look at that LOS. There's a calculate. So we need to get out our financial calculator. So we're given some input variables for the debt, input variables for the fixed income security. So let's go ahead and compute the weighted average cost of debt. Well, the first thing we can do is compute the weights. So let's just take 4 out of 6 is the equity weight. 2 out of 6 is the debt weight, right? We get that equity. 400 million, debt is 200 million. So if you add the 4 and the 2, you get 600 million. So there's the denominator. 4 divided by 6, that's 2/3. 2 divided by 6, that's 1/3. There are the component costs over on the right-hand column, 20% for equity, 10% for debt. So what was I saying earlier? You most likely be given that 20 and that 10% in the question stem, comma, there will be other LOSs out there in future learning modules where we'll have to go ahead and compute those. So all we're going to do is take a weighted average of those two. Now remember, I'm guessing that on the exam, answer choice A is going to be 15%, right? 20 and 10, halfway between those two is 15%. Don't be tempted to go ahead and put the simple and what appears to be the obvious answer, because the weights are different, right? There's 400 in equity, there's 200 in debt. Now, if those two numbers were 300 each, well, then you could go ahead and do half of 20 and half of 10, but you would still be incorrect because the bond has a tax advantage. So notice what we've done. We put it in red for you. 1 minus that tax rate is given to you there, 30%. 1 minus that tax rate. So make sure you don't take a simple average, and make sure that you don't forget about the 1 minus the tax rate. This is a common mistake that my students make on exams all the time, and I beg them not to make the mistakes. I beg them, but they still do. All right, how about some factors impacting or affecting capital structure? So what do we know? Think about the right-hand side of the balance sheet. Think about the debt up at the top right-hand. This is the lower cost, right? It has a finite date to maturity. That could be 10 years or 30 years. I mean, most bonds are issued in 30-year increment, or with a 30-year maturity. There's nothing really interesting about 30 years. It's something that the government came up with thousands of years ago. But 30 is not interesting at all. Back in the late 1990s, Coca-Cola and Walt Disney issued 100-year bonds. But the point is, there is a maturity date on a fixed income security, and the executives make an explicit promise. This is worth repeating. I promise to pay interest. I promise to pay principal. The promise made to the shareholders, on the other hand, is something that I call, this is not out of the Institute, but I call it a vague promise. The promise is to the shareholders, look, if we do really, really well with all of your capital, I might pay you a dividend, but I don't have to pay you a dividend. It depends on what the board of directors are thinking. And even if I don't pay you a dividend, there's nothing you can do about it. But if we're successful, I'll very likely pay you a dividend. And what's even better is that because the goal of the business is to maximize shareholder wealth, which can be observed by a ballooning equity portion of the balance sheet, the shareholders will be able to go to the New York Stock Exchange and buy low and sell high. All right. Equity. What do we say here in this slide? It's expensive. It's permanent. Lots and lots of flexibility. But the shareholders, they get to share in that future profitability, which means they can get dividends over their lifetime. But the more important second component of that vague promise is the idea and the notion of a potential capital gain. So think about explicit promise and vague promise, and then memorize these factors here. So what are some internal, inside of the company factors that are going to impact capital structure? So think about those internal factors. I mean, those are generated in general by the business model and the attitude that the board of directors has towards total risk and attitudes towards leverage. Do we want to have lots of leverage? Do we want to have minimal leverage? In other learning module recordings, we'll have great conversations about financial leverage ratios. And these are super important here to determine each one of those block points. External factors, of course, are market conditions. Let's go ahead and talk about a few of them. Things like what's the shape of the yield curve? Are we borrowing in the short term at low interest rates and then borrowing in the long term at higher interest rates? That would be an upward sloping yield curve. We also have to look outside of our internal factors to factors that are unique to our industry, right? So we have to take a look at what our peers, what our competitors are doing. And one way we'll do that is through the comparison of our leverage ratios versus our competitors' leverage ratios. And then, of course, we cannot operate without the government out there. The government is always interested in stuff that we're doing. And so, especially if we're a financial institution, you guys know this better than I do, probably living your daily life, wondering what is the federal government or what is the state government going to do today? The federal government could come in one day and say, you know what, we want banks to be really safe, so we're going to make them keep 80% of their deposits as cash on hand. And then, of course, if that were to happen, stock prices in the financial institution industry would plummet. Probably wouldn't go to zero, but some of them might. All right, how about the difference between capital intensive businesses and capital light businesses? This sounds like a really great exam question to me. So capital intensive. So think of a company like Harley-Davidson. What does Harley-Davidson have? If you ever go into one of their manufacturing facilities, they have tons and tons of these huge metal stamping machines. Well, how do you pay for it? Well, Harley-Davidson is going to go to the bondholders because the bondholders are going to charge the least yield to maturity or the lowest interest rate. Yeah, so what that means then is that these firms, they tend to issue lots and lots of debt, and those bond covenants are probably tied to the assets. In other words, we'll call that a secured fixed income security. If Harley-Davidson fails, then the bondholders can force the executive leadership team to sell a particular or a series of particular assets so the bondholders can get their money back. Now, they're probably not going to get all their money back, but they might get most of their money back. And then I did mention financial institutions earlier, so there you go in that third column, that third diamond point. What about capital light businesses? These are businesses that have minimal fixed investments. I mean, if you close your eyes and you think about a company like Microsoft. What does Microsoft do? Well, they do stuff inside of a computer. So they don't need huge metal stamping machines to be able to generate an operating cash flow. So they have less debt. They might have lots and lots of cash available. They might have lots and lots of intangible assets, like trademarks. So typically these software companies, these technology companies, they work and they provide their service for other companies that use theirs, right? So they're probably going to be able to generate lots and lots of cash flows up front. So there we go. Customers are charged up front. Now, because these tend to be considered growth companies because they're not encumbered by debt, among other things, among other reasons of why they might be called growth companies, that lots and lots of times the executive leadership team and middle managers, they'll go ahead and say something like, you know what, you can pay me, this salary, but what I want is I want stock options as part of my compensation. And that's okay. That's okay. However, you got to worry about this. Now, let's take the role as a good wealth advisor. If we have a client that works for a software company and they're getting their income from this company and they're getting compensation in the form of shares of stock or stock options, well, then we need to make sure that we are worried about diversifying their portfolio. All right, how about the company life cycle? This is tied into and is very similar, not identical, but it's very similar to the conversation we have on the general business cycle that's out there. So startup stage, what do we have? We have some revenues, maybe we even have zero revenues. Business risk is high. This is what I was saying about Jim's concrete company a little bit earlier. So how do we raise capital? Well, what we probably do is we probably go to our family members and say, oh, you know what? Do you remember how cool I was back in the 9th grade? I got this great idea for a business. All right, so we get to the family members. Now, if we go to the bank is going to say, you know what? You probably don't have the assets. You have no revenues. You have negative cash flow. We're not going to lend you any money. So we have to go to maybe the private equity market, maybe venture capital, maybe some kind of a foundation. Maybe we could get a grant, maybe. Now, that doesn't mean that debt financing is totally unavailable. What we could do is we could do lots of leasing, which is similar to debt, but it's not considered to be, exactly long-term debt like a bond issue is. But then lots of these startup companies, they'll offer convertible debt, which says something like, you know what, send me your money today, and if I'm successful, you can convert your bonds into shares of stock. All right, so what happens then? We get this let me go back here real quick. We have the startup stage. Essentially, nobody loves us in the startup stage. We have to put on a show to convince people to lend us money. And they're going to say, you know what, you can have our money, but we're going to charge you a high interest rate. So then what happens? It starts to materialize. We start having rising revenues, and all those people over there who weren't happy with us, they're starting to say, hey, Jim might be onto something, rising revenues, accelerating growth, generating operating cash flow. However, free cash flow might be negative. So let me just remind you, operating cash flow, the amount of cash remaining after all expenses have been paid. So that's probably positive and accelerating. Free cash flow, on the other hand, could be negative. Let me give you that definition for free cash flow. The amount of cash remaining after all expenses have been paid and all investments have been made. So we're generating these operating cash flows and we're just reinvesting them back into the company. We're building up our asset base. We're building up our network. We're building up our supply chain relationships. So cash flow might even be negative. Business risk decrease, cash flows they're increasing. We might now have more and more fixed assets, so we might be able to issue some kind of bonds. However, in the growth stage, we're almost solely relying on equity as a source of capital. Then we hit this mature stage. This is the stage where at the beginning, our product line is on the cusp of becoming a brand name. And then at the end of the mature stage, then our product line is a brand name. Revenue growth slows. Business risk is super low. Free cash flows, they're positive and reliable. You've heard me say this in recordings over time. Sustainable operating cash flows ultimately leads to sustainable free cash flows. This is when you know a company is super, super successful. Now look at that. What is that? The fifth block point down. There, deleveraging occurs over time because we owe the bondholders a bunch of money, and what are we doing? We're growing, we're maturing, we're doing this so we can pay off the bondholders because of, continuous cash flows. I like to think of it in terms of sustainable cash flows. Here, get your phone out, take a picture of this slide. This is a really good one. Great idea down the left-hand column. What are the life cycles and what are the consequences of the life cycle? So growth, free cash flow, business risk, etc. Startup, growth, and mature. This is a good picture. This is a good slide to memorize, not just for this particular LOS, but as we move through the program. All right, how about we look at the component costs of capital, right? The cost of debt and the cost of equity. And let's look at this from a top-down approach. Top-down meaning we're going to start with the macro economy and then work our way down. So macro economy, then we look at the industry, and then we look at our chief competitors, and then we look at our individual firms. So we go from super large down to super small. So what are these macroeconomic conditions? And don't forget that these are unique and specific to each country. Well, we know this from our economics learning module. We need to worry about things like the Fed, right? Here in the United States, central bank, what's its attitude on monetary policy? We need to worry about Congress, what's their attitude on fiscal policy? So spending and money supply, that's going to impact GDP growth rates. It's going to impact inflation. Of course, we're going to hit the borders, and we're going to want to import and export. So currency value fluctuations. All of these things have an impact on interest rates, and that's going to affect the spread on our cost of debt versus the yield to maturity on a government bond. So threats of recession, what happens when interest rates are low. Here we go to the industry conditions. What is happening in the industry? Of course, the energy industry has its own unique economic factors. The software industry has its own unique economic factors. So we need to become experts on industry analysis. And then we get down to a measure of our issuer specific, our company. And don't forget, we need to, whenever we compute these ratios, and here's a couple of them there, we need to do two things after we compute these ratios. Look at a time series. Let's go back over the last, let's say, 12 quarters or so, and look at what these ratios are doing over time. And then we need to compare them to our competing firms. So we know where we are inside of our company and then our chief competitors. So what are some good ratios here? Interest coverage and financial leverage, profitability ratios. There's some operating leverage, sales risk, collateral. So essentially what we're doing in computing these ratios, and these are super easy to compute and easy to interpret it, but let me give you some kind of a sense here. All we're really doing is saying, okay, we're issuing a bond, let's say it's for $100. We're agreeing to pay $10 in interest to the bondholders every year. So what that means that we need to make at least $10 in earnings before interest and taxes so that we can pay off our bondholders. So interest coverage ratio, that's what that tells us. Financial leverage, that tells us, kind of a global picture. How much debt do we have in relation to our assets or our equity? So here's a good financial leverage ratio, total debt over total equity. This is right-hand side of the balance sheet. All we're doing is taking the top and we're dividing it by the bottom. And then we can look at some business risks. We can take fixed costs over total costs, and we can add or subtract, anything else that we want to throw into these ratios, considering the risks of what is the rate of change in our revenues, what is the rate of change in our expenses, if we want to throw those in there. And then what kind of collateral do we have? Think of my Harley-Davidson example. They got these huge metal stamping machines. If Harley-Davidson went bankrupt, it could probably sell those to another motorcycle manufacturing firm because Harley-Davidson been around for a long, long time. Those machines probably work. All right, one quick last slide before I get into this concept of Modigliani-Miller. Look at the equation there in the middle. This is the exact equation that we looked at in the beginning. However, it's in a different form. So we give you this in one of two forms. The Institute can say, here's the weight in debt, like 40% and 60%, or they could give you the actual dollar amounts of debt and the dollar amounts of equity, and then you would have to compute that. That's why we have the red and the blue. Once again, don't forget the 1 minus the tax rate on the debt side. So let me say one more thing before we get into M&M here. What's the goal of the business? Maximize the value of the firm. How do we do this? Well, I'm going to repeat myself. We find projects that have lots and lots of sustainable cash flow. And then the second component that we haven't talked about yet, but here it is right now. The second component is that when we issue a bond and we issue shares of stock, we find those investors over there who are willing to lend us that capital at the lowest possible interest rate. So one way to maximize the value of the firm is to minimize the weighted average cost of capital. All right, let's go ahead and talk about these two dudes here. 1958, They're essentially the fathers and the creation of finance as a discipline. I remember all these dudes back in the 50s and the 60s, they had PhDs in economics. There was no such thing as finance. So they're in the field of economics and they're not quite sure it's economics. It's clearly not statistics. It's something new. And so Modigliani and Miller came up with this. They wrote this really, really cool paper in 1958. I get the paper out once a year and read it because it just reminds me how amazing it is. And of course, these two guys won the Nobel Prize in economics for this work. But what they did is they said, you know what, we don't have a formal model to compute the value of a company. I mean, we had the accountants to be able to tell us that, oh, here's book value, here's this kind of stuff. We have the economists who can say, oh, well, here's GDP, here's the elasticity of demand. You can go ahead and compute P times Q. You can do all that stuff. But there was no formal model of finance. Well, this is what M&M did in 1958, and they created what's known as the M&M world. And the M&M world, I like to think of it as almost a fantasy world. It's really not a world that exists today. And M&M were slightly criticized back in the late 1950s for creating this world that didn't have a lot of reflection on reality. But Modigliani and Miller were smarter than the rest of us. They said something like, you know what? In order to understand reality, we need to start at a place, a super simple fantasy world, so we can understand the basic drivers of value. Then we can relax all of these assumptions and voila, as my mother said to me, we can determine the value of a company. I always tell my students that I equate this M&M world to the fantasy world that Kramer lived in back on Seinfeld. Here's your homework assignment. Go watch the episode where Kramer goes to the Yankee fantasy baseball camp and he ends up punching and knocking out Mickey Mantle. What a funny episode that is. So here's a great exam question, right? What are the assumptions behind this M&M model? And as I go through these, you're going to say, you know what, Jim? These are not very realistic assumptions. But don't be upset about the unrealism. Is that a word? The lack of realism in these assumptions, because before we get to the end of this slide deck, we're going to relax a bunch of these assumptions and we're going to be able to make real lifetime decisions. All right, homogeneous expectations. This simply means that you and I and all of the bondholders and the shareholders out there, not only do we have the same information set, but we agree, homogeneous expectations. We agree on a company's expected cash flows, whether they're just some kind of accounting profit or operating cash flows or free cash flows. We all agree on what those things are. Perfect capital markets. There's no such things as investment banking firms, so there are no transaction costs. There's no government out there to tax us. There's no threat of bankruptcy. There are no agency costs, which we've talked about before. Here's another one. All of these homogeneous investors can borrow and lend at the risk-free rate. There's another one in the blue, no agency costs. A lot of times I'll throw that up into no perfect capital markets. And the financing decision made by the executives is different from the investment decision. What that means is the executives look at the balance sheet on the right-hand side, what we've been talking about all along, whether to issue debt or equity. That doesn't dictate what we're going to do with the capital, right? What can Harley-Davidson do? They can issue a bond, they can issue shares of stock, and they can use that capital to invest in, let's say some kind of a new product line. Didn't we just talk about expansion of new product lines? Suppose Harley-Davidson wanted to manufacture golf carts. Well, they could issue a little bit of a bond and a lot of shares of stock, or a lot of a bond and little shares of stock. That decision over there, the financing decision, is not going to influence whether or not Harley-Davidson goes into the golf cart market. How cool would that be? Driving around a golf course on a hog. Imagine how fast you could get out into the fairway. I'm suggesting they don't do this because my son is the craziest golf cart driver that ever lived. All right, here we go. inside of those assumptions that we made on that previous slide, Modigliani-Miller also assumed that the firm had no growth opportunities, which means it's going to have a constant and fixed level of profitability. All right, so keep that in mind. So there's proposition 1 at the top. The market value of the company is not affected by the capital structure of the firm. This is called the capital structure irrelevance proposition. So I'm going to show you here in the next handful of slides how that exactly works. To do that, we need a formal model to compute or to estimate the value of the firm. So what Modigliani-Miller assumed is that the value of the levered company, a company with bonds on the right-hand side of the balance sheet, is identical to the value of a company that has no bonds, levered versus unlevered. So the value of the firm is nothing more than the present value of its profitability. So in 1958, that measure of profitability for Modigliani-Miller was what's in the numerator there, earnings before interest and taxes. Now, in these days, we could substitute operating cash flow and free cash flow or some other measure of cash flow in the numerator, and it wouldn't change the model at all. But this is what M&M were stuck with or limited to back in 1958. So I want you to think about this. How do we compute the present value of a perpetuity? Well, all we do is take that perpetuity and we divide by the interest rate. Here, let me give you a quick example. Suppose I promise to pay you $10 forever and ever and ever and ever, and you require a 10% rate of return. How much are you going to pay me for that security? Well, $100. Take the $10 divided by the decimal form of the interest rate, 10%. So $100 today will finance a $10 payment in perpetuity. So that's the model there in the middle of the page. All we're doing is taking a measure of profitability and dividing it by what we talked about here so far in this slide deck, the weighted average cost of capital. There's the formula at the bottom. Same thing we've done before. Notice there's no 1 minus the tax rate on the debt side of that equation, because what are we doing? We are ignoring taxes because there is no government out there to reward us with a tax subsidy. Proposition 2 is related to Proposition 1 in the following sense. It says something like, all right, if we start with a firm that has no leverage, no bonds outstanding, and we start issuing bonds, well, what happens then is that the interest rate on the equity, right? We're going to call that the required return of equity or the cost of equity. This increases in a linear fashion. So let me read Proposition 2. The cost of equity is a linear function of the company's debt equity ratio. So look in the middle there. There is the required return on equity, R sub E, or the cost of equity. We're going to start with R sub 0, which is the cost of capital, if there is no debt financing. And then we're going to add this linearity relationship to it. And notice the linearity depends on the debt to equity ratio. All right, so that's Proposition 1. Proposition 2. What does that LOS explain those with regarding to capital structure? So the last 5 minutes ought to be able to help you answer those questions. All right, what are some implications of this second proposition? What's going to happen is that when we increase the leverage, we're going to increase the cost of equity. In fact, we're also going to increase the cost of debt, although Modigliani-Miller assumed risk-free debt back in their 1958. But we could assume that cost of debt is also going to be increased. However, since we're using a higher proportion of the lower cost, the company's value does not change. Oh my gosh, this is really just the most amazing thing. In fact, when I show you this mathematically here in just a second, I'm going to get up and run around my office here and do some cartwheels. Wouldn't it be awesome if I could do a cartwheel here? All right, let's do an example. All right, so we have this company. It's no debt in its capital structure, only equity. annual cash flow of 10,000. All right, so there's what I was saying earlier. Could be profitability, could be operating cash flow, could be free cash flow, could be some other measure of cash flow. There we go. Cost of equity is 10%. So we have 4 charges here. We want to go through the math based on the last handful of slides. I want to prove all of this stuff to you. All right, so let's do the first one. So what is the company's value? Well, all we're going to do is take that annual cash flow, $10,000. Now, remember, the Institute could give this to you in terms of EBIT, so that's fine. Just put EBIT in the numerator or cash flow in the numerator, divided by, and this is important, the decimal form of the cost of equity, and that gets us $100,000. All right, part 2 asks us, what happens if the company is planning to issue $20,000 in debt at a cost of 5% and use the proceeds to repurchase the stock? All right, so this is interesting. This was very important. Remember what I said earlier? This firm has no growth opportunities. So then it doesn't have any motivation to issue any bonds, right? However, what it does and can do is that it can issue bonds and use those proceeds, in this case 20,000, to repurchase some of its stock. What's happening here? We're going from an all equity firm now to a levered firm. And the question is, what happens? What happens to all this stuff that we have been talking about? Well, let's go ahead and first compute that new cost of equity. So we're just going to start with, well, there it is, 10%, then take the difference between the 10% and the 5, right? What are we told up above? The cost of debt is 5%. By the way, that's the yield to maturity on the bond. And then we're going to weight that by the debt equity ratio. So we've got the $20,000 divided by the 80,000. So what did we start with? We started with $100,000. What did we get? 100,000. So there we go, $100,000 in equity. What are we going to do? We're going to take 20,000, issue a bond, and repurchase 20,000 of the equity. So we just have 2 out of 8 now, instead of previously 0 out of 10. 0 out of 100. Everybody get that? So that gives us an 11.25% cost of equity. This makes perfect sense, right? If we have more leverage, we have more risk. The shareholders now have to worry about the firm. Now remember, this is a no-growth firm. It has to worry about the firm making the annual or semi-annual coupon payments to the bondholder. So this constant cash flow has to go somewhere else before it gets to the shareholders. So it should make perfect sense that the cost of equity, which was 10% before the bond issue, is now 11.25% after the bond issue. Remember, back in 1958, nobody had any idea how to compute that 11.25%. So Modigliani-Miller come along and formalize this model, and they say, okay, everybody knows cost of equity is going to rise. It's going to rise to that number right there. Imagine the value of this formal model in this simple fantasy world had to investors and executives back in 1958. All right, so here's the third one here. This is super cool. What was that proposition 1? Value of the firm is not impacted by the capital structure decision. What that must mean then is that the weighted average cost of capital, it can't change. It has to remain the same after the bond issue. Well, let's go ahead and compute it, right? Now our weight in debt is 20 out of 100. Our weight in equity is 80 out of 100. The yield to maturity, or the cost of debt, is 5%. The required return on equity, or the cost of equity, is 11.25, which we just calculated. And if you do all the math, you get 10%. Wow, that's the same as it was before. Look up at the top there. Cost of equity is 10%. So what did Modigliani just show us in this highly restrictive world? They showed us that when a company issues a bond, it doesn't impact the weighted average cost of capital, and therefore it won't impact the value of the firm. So this fourth charge here asks us to show the company's value. So here's what Modigliani-Miller also showed us. They used the fundamental accounting equation that total assets equals total liabilities plus total equity. So the value of the company has to be the value of the debt, which is 1,000 divided by the 0.05. Now that 5,000 is simply, what did we do? We issued $20,000 in bonds. We promised 5%, right? So 5% of 20,000 is 1,000. So the value of the debt, 1,000. Now this is in perpetuity, remember, 1,000 over 5% plus. Now we're left with just 9,000, right? We had cash flow of 10, but we had to pay the bondholders 1. So the shareholders only have access to 9. Oh, this makes perfect sense now. Look, we have to discount that at a higher rate. What did we do before? Here, it's worth going back here. Let me do this. We discounted that 10,000 at the 10% cost of equity to get our 100,000 because the shareholders had a claim on all of that 10,000. But now the shareholders only have a claim on 9,000. Because 1,000 goes to the bondholders, but we're dividing it by a higher rate. Boy, if you do the math, what do you get? You get the same $100,000. All right, if I were athletic like I used to be, I'd run around my office here and do cartwheels. So I'm not going to do that because I don't want to go back into the hospital and have another hip replacement. All right, so here's the next question. The question is, all right, Modigliani-Miller, you dudes have given us a great amount of stuff to think about. Well, what could we do if we relax some of these assumptions? Well, let's do the most obvious assumption, right? The tax shield. There's a government out there, and the government goes ahead and says something like, wait a minute, we're not letting you get away with not paying any taxes. So what happens to the value of the company if we throw in a tax rate? So look at the 2 diamond points. The interest paid shows up on the income statement. So it is tax deductible, which means it lowers the tax liability. So this provides us with a tax subsidy. So the value of the firm then is equal to the value of the unlevered firm plus the value of the tax shield. So look over there on the right, the value of the tax shield is the total debt times the tax rate. What we can do is we can use that stuff in the red block and put it into an equation down here. The value of the unlevered firm is equal to profitability times 1 minus the tax rate, because not only are we going to have this show up on the income statement, it gives us a tax subsidy, but we're going to have to pay an income tax as well. Divide that by the weighted average cost of capital. Now, this leads to what we call in calculus a corner solution. This is really a silly result. So look at the implications. In the presence of taxes, a profitable company, it has to be profitable, it can increase its value by just simply issuing a bond. So every day the chief financial officer can get up and he or she can say, oh, I'm going to issue a bond, and the value of the company goes up. I'm going to issue another bond, the value of the company goes up. But here's the thing, inside of this Modigliani-Miller framework, since it's a no-growth firm, we're going to issue a bond and repurchase shares. Issue a bond and repurchase shares. Issue a bond and repurchase shares. Sooner or later, we're going to run out of shares to repurchase. This is the corner solution that I'm suggesting, is that there is an optimal capital structure here, M&M Proposition 1 with taxes, and that optimal capital structure is 100% debt. Now, of course, we don't see that ever. We don't see a firm financed with 100% debt. I imagine there are some out there historically through restructuring and bankruptcy and equity carve-outs and all that kind of fun stuff. But this is a crazy corner solution that really doesn't tell us a whole lot other than it illustrates, and this is so important, it illustrates the value of the tax shield. Now, the next question is, what happens to Proposition 2? The linear function stays the same, but we need to adjust it by the tax rate. So look in the red box, we just throw that 1 minus the tax rate in there and everything else stays the same. I don't think this is an interesting question on the exam, but be prepared to compute the where am I here? Prepared to compute the value of that unlevered firm using that equation down at the bottom, and be prepared to calculate the cost of equity with these taxes. Go ahead and take a picture of this. This will help you memorize this. So let's go ahead and work through an example. Here we're using EBIT profitability. So there's 6,000. We have a bunch of other stuff. Calculate the value of the firm with taxes. Calculate the value of the firm and the cost of equity with taxes, proposition 2. The first part of these calculations are super simple. Let's just go ahead and take that EBIT, multiply it by 1 minus the tax rate, divide it by the decimal form of the weighted average cost of capital, so we get that 35,000. And then to get the value of the tax subsidy, let's take that 18,000 in debt, multiply it by the tax rate, and so we get the value of the levered company over there, $40,400. So that's the super easy part here. The second part takes a little bit of more discipline and understanding and some calculations. So let's go ahead and work on that cost of equity. So look at that RE there. What are we doing? We're starting with our 12%, right? That was given to us. Weighted average cost of capital. There's 12%. What we're going to do is we're going to add the difference between the 12% and we're given the 6% cost of debt back here, and we're going to multiply that by 1 minus the tax rate. Now remember, we didn't do that in the first computation with in the original Modigliani-Miller world. So don't forget that 1 minus the 30%, because you know the Institute is going to have as one of your choices the answer where you had forgotten to get that 1 minus the 30%. So what is the debt? There's the amount of debt in the numerator there, 18,000. And so all we need to do is then get the denominator. So take the 18,000 from the, what did we do back here? We did the 40,400. There's our value of the levered company. So 18 goes in the numerator, 22,400 goes in the denominator. And you get the, what is that? About 15%. Now let's go ahead and use this stuff to prove some of the things that we have been talking about earlier. So let's go ahead and do our Modigliani-Miller stuff that we did with, this is what we did earlier, the 1,000 and the 9,000. So Modigliani-Miller tell us value of the firm is equal to the value of the debt. All right, so let's take that interest payment on the debt, which was 18,000 times the 6%. We'll go ahead and divide by that 0.06, and we'll add the EBIT, which was given to us as 6,000, minus the interest payments on the debt, which is the 1080. Don't forget to multiply it by the 1 minus 30. But now we're going to divide by the new weighted average cost of capital, right? That 15,375, and lo and behold, there we go. We get the 40,400, which we got back here using this old simple method, but now we're proving it using the Modigliani-Miller formal way of assigning a value to the firm. Now, what we can do is we can go ahead and compute this new weighted average cost of capital using the simple math that we did where was that? Actually, I'm not sure if I mentioned that. That was in the blue box. This was above the red box. So there, the blue box, I don't think I mentioned that in that earlier slide. But there we're calculating, kind of the new weighted average cost of capital after the bond issue. So you throw those numbers in there. Notice that we conveniently put red, the 15,375. That's what we computed up there so that you don't make that mistake. There we go, 10.4%. And here's the cool thing at the end. You use that 10.4% in the denominator, just like we did over here, right? There's value of the unlevered company. But now we can compute the value of the levered company, and it turns out to be $40,400. So what has Modigliani-Miller taught us? They've taught us here with Proposition 1 and Proposition 2, both with and without taxes. They've taught us what is important in terms of valuing a company. I'm going to come back to that comment here in just a second. What we need to do is we need to continue relaxing some of these assumptions. So one of those assumptions that we had was that we were in a perfect capital market. One of the consequences and implications of a perfect capital market is the simple fact that there's no such thing as bankruptcy. So what do we know about bankruptcy? We know that there are direct costs and there are indirect costs. And one of the cool things that I learned when I was in graduate school, I never heard about this before, I'm not quite sure, maybe I just wasn't paying attention as an undergraduate, is that the bankruptcy cost gives you kind of the sense that we're in bankruptcy, we're in a court, and things are really, really bad. But what the academic world contributed, going back to, somewhere around 1976, is let's call these things financial distress costs. There are direct costs and there are indirect costs. So the direct costs are that traditional cost of bankruptcy, right? Paying the lawyer, paying the court fees, doing all that stuff, direct costs associated with bankruptcy. But there is financial distress before we actually have to go into bankruptcy court. Here's the example that I give my students. Suppose I'm just a mean supervisor. I'm a mean chief financial officer, and I know that I have a coupon payment that's due tomorrow, and I don't have the cash to pay it today. So what do? I come into work, and remember, I'm a mean guy. So I come into work and I just yell at everybody. I'm like, what are you people doing? I have a coupon payment to make tomorrow, and you guys have failed me. All right, so I do all the yelling. What does that mean? That means that all of my workers, all of the people in my supply chain, all the financial institutions that I'm dealing with, they're looking at me and saying, boy, Jim is stressing out. He's freaking out his workforce, and so they're under stress. All right, so that's kind of a simple example. Maybe it's a crazy example. Maybe it's not even a good example, but look, what are these indirect costs? Of course, I'm going to lose customers, the creditors, the suppliers, valuable employees. They're mad at me. They're going to quit, right? And then there are going to be all these agency costs associated with debt. So this is what we know. When a firm has lots of leverage, it's going to be approaching the point of bankruptcy, which means it's going to have financial distress costs. So in those first two scenarios under Modigliani-Miller, we ignored this stuff, but we know these are super real. So the question then becomes, how do we incorporate financial distress costs into our Modigliani-Miller model? And the answer is that it's just super easy. Look in the middle there. Value of the levered firm is going to be equal to, well, what M&M taught us, value of the unlevered firm, plus what M&M taught us, the subsidy value, the tax advantage of debt, but we're going to subtract out these financial distress costs. And we're not just going to estimate those financial distress costs. We're going to take the present value of them. So think about this. The value of the company increases with debt issued because of the tax subsidy. But once it hits a certain point of leverage, it decreases the value of the firm. So I'm going to show you a graph here, and it's worth high-fiving each other over. This is the ultimate result of the 1958 Modigliani-Miller Proposition 1 and Proposition 2. All right, you ready for this? So notice what's on the horizontal axis. There's just our level of debt. It could be a debt equity ratio. It could be a debt to asset ratio, just some measure of leverage. On the vertical axis is going to be the value of the firm. All right, so what do? We go up until we hit the horizontal line, the value of the unlevered firm. That's the value that M&M show us back in Proposition 1 and Proposition 2. Let me just remind you that the value of the unlevered firm at no debt is the same as the value of the unlevered firm at lots and lots of debt. So what did Modigliani-Miller tell us? They told us the value of the firm is independent of its capital structure. That's that first horizontal line. So you ready for this? This, in my mind, is the great contribution of M&M in 1958. M&M said, you know what? When you're valuing a firm, you have to consider two factors. And they are the quality of the assets and the interest rate charged by investors. All right, I'm going to go back here because this is worth it. This is worth it. Where I'm going to go way back. I'm going to go way, way back. Wasn't there a cartoon, The Wayback Machine? I bet you guys never even heard of that. There's your homework assignment. Go watch the cartoon with the Wayback Machine. What did Modigliani and Miller tell us here? This is the initial result of their Proposition 1, but the Proposition 2 as well, that the value of the company, in this case $100,000, depends on the quality of the asset. What am I saying? It depends on the ability of the executive leadership team to invest in assets that have tons and tons of operating and sustainable cash flows, right? What do we want? As shareholders and bondholders, we want lots and lots of numerator. How do we get lots and lots of numerator? We invest in product lines that are brand names. And then we divide by, what did we say earlier? The minimum interest rate, right? We want to borrow money from the bondholders and the shareholders at the lowest rate possible. So let me fast forward all the way to this really cool graph. So there we go. So what are we doing in this horizontal line? This is Modigliani and Miller telling us the value of the firm depends on the quality of the asset and the weighted average cost of capital. But then we can increase value by just simply issuing a bond. So that's that linear relationship there in that first part, right? So what are we doing? We're upward sloping. Notice in the blue shaded area, this is the present value of the tax shield. Oh my gosh, that goes all the way out. That goes all the way out to a corner solution at the top right. But hold, not so fast, my friends, as Lee Corso says on game day on Saturdays. What happens when we issue too much debt, when we have too much leverage, the threat of bankruptcy, the cost of financial distress, they start eating into the tax advantage of a bond. So what happens? That blue line starts peaking and then it slopes downward. So what do we have? We have D star. We have an optimal amount of debt. So what did Modigliani and Miller tell us? They said the value of the firm depends on the quality of the asset, depends on the weighted average cost of capital, and it depends on the executives being able to find the optimal amount of debt on the right-hand side of the balance sheet. This is why we pay the executive leadership team several millions of dollars a year in salary, and then we compensate them with stock options and lots of perks, because these are really, really smart men and women that can invest in sustainable product lines and find the optimal capital structure. Wow, this is super, super cool. Go ahead and give me a high five. All right, so what does this optimal capital structure means? It means that when a firm has low levels of debt, what it can do is it can just increase their leverage, and the tax benefit exceeds the financial costs, financial distress costs. That's where we're going in that upward slope. So this is nothing more than marginal costs and marginal benefit, right? There's a marginal benefit of debt, the tax shield. There's a marginal cost of debt, the financial distress costs. Well, what do? That optimal amount of debt is where the marginal cost and the marginal benefit of debt is identical. So D star is that optimal capital structure. What does that mean? Company's value is maximized. Super cool stuff. All right, so let's take a deep breath and say, you know what, boy, that was awesome. This was like when a couple years ago I took my boys to a Kiss concert, and oh my gosh, the Kiss it was awesome. I mean, one of my sons said, "Hey, Dad, how many more songs do you think they're going to play?" Anyway, so at the end, we're just rocking and rolling. We're having a great time, but now the concert was over, and we're waiting for the encore. So here's the encore. And of course, they came out and played rock and roll all night and party every day. And the confetti was flying down, and both of my sons were jumping up and down. And I, as a 60-year-old old-time dude, by the way, I'm younger than all the guys in KISS. So here's the encore. The question then becomes, all right, we can use all that Modigliani and Miller stuff, But how is it possible for us to identify that optimal amount of debt? Keeping in mind that market values of debt and market values of equity, they change every day, right? We have the floor of the New York Stock Exchange. We have a bond exchange. So how do we find that optimal amount of debt? Well, the answer is pretty much we don't. We have this target capital structure. And so the executives say, you know what? We think our optimal debt equity ratio is, let me just pick a number, 0.6. But what we want to do is we want to target it. We want to say we want to keep it between 0.55 and 0.65. So there's our target capital structure, which then allows the markets to fluctuate, right? Up and down. And it doesn't tie us in to one specific debt level or debt equity ratio. So what do we have in that second bullet point, right? As a close range of optimal capital structure, right? Considering tax rates, business risk, financial accounting, all that kind of stuff. Now that means that the actual capital structure on any given day hopefully will be within that range, but it might over the short term fall outside of that range. And that is probably because of the executive leadership team looking at short-term opportunities. Oh, remember we had good learning modules on working capital management. We had good conversations on bond issuing. So tactically, the executives can jump into the market and issue a bond or repurchase shares, do whatever they want. And that might put us away from the optimal capital structure. Remember, this is a long-term number, and it might fall outside of that target capital structure range. But over the long term, we're going to be inside of those numbers. What did I say? 55% to 65%. Yeah, optimal capital structure uses market value. Target capital structure is going to look at market value, but it might use book value. So be careful when you answer this question here on the exam. And the reason that target capital structure, actually executives, they use different measures of value. So they'll do both market value. But for our purposes and exam purposes, remember target capital structure is probably book value. Which means then what we can do is we can compute the company's weighted average cost of capital using some kind of target weights. And so here we go. These are just ways of doing this. Proportion of each capital, we know all this. If we know the target capital structure, now remember, the executive leadership team will know what that target capital structure. As good financial analysts, we probably don't know it. I mean, we could ask, right? But if it's not disclosed by the company, we'll have to guess. So how do we do that? Well, the Institute is teaching us how to do that. They're going to teach us throughout level 1 and level 2 and level 3 to look at the historical ratios of a company, look at the financial decisions that the executive leadership team and the board of directors has made, take a look at competitors, take a look at the industry, and we might be able to estimate with some degree of accuracy what that target rate is going to be. So there's a little summary in the purple down there. Assume current capital structure and market value weights as a representative of the company's target structure. I mean, that makes sense. That's a simple idea, but we can use all this process to maybe expand or contract those weights. All right, so let's finish up here. Pecking order theory. This is super simple. This just says that the executives, when issuing a bond, when deciding on whether or not to issue a bond, they have to consider the simple fact that the interest rates on the right-hand side of the balance sheet are different. So look down at the bottom. Here's the summary. So when we need financing, what's the best thing to do? The best thing is just to go over on the top left of the balance sheet and say, hey, how much cash do we have? If I need $100 million to do some expansion and I have $100 million in cash, why don't I just use that? All right, so first preferred finance method is for internally generated funds, then debt, because debt is the cheapest cost, plus it provides a tax advantage, and then finally equity. But remember now, this pecking order theory has nothing to do with that really cool graph that we talked about earlier. All right, let's finish up quickly here. Modigliani and Miller, they talk about a perfect market, which means there are no such things as agency cost. However, Michael Jensen in 1986, he has this idea about free cash flow. So in the context of capital structure, we need to ask ourselves the question, what happens if a company is generating lots and lots of cash flow? I said this earlier. If a company has lots of cash flow, it's going to say something like the following. If I'm the executive and I have $1 trillion in free cash flow, I'm going to say, you know what? I'm really the greatest executive that ever lived. I deserve a slice of that $1 trillion in free cash flow. I'm going to take some of it. I'm going to give myself a bonus. I'm going to take some of it and I'm going to award myself some stock options. I'm going to take some of it and I'm going to build myself a bigger office. I'm going to hire a second administrative or a third administrative assistant. I need a membership in the country club. I need limousine service. I need a seat on the space shuttle. I need all these things. So when a firm is super successful, it tends to consume these perks and benefits. Now, remember, this agency explanation tells us that, hey, look, the board of directors is responsible for compensating the executive leadership team. So the board has oversight over what I get to consume. However, I'm going to do stuff as the executive to try to overconsume, right? We call these excess consumption of perks. So here's what Jensen said, this free cash flow hypothesis that Jensen says, no matter how much cash is sitting around on the balance sheet, he is suggesting that the firm go to the market. Go ahead and issue a bond. Because if you have tons and tons of cash on the balance sheet, Moody's and Standard & Poor's is probably going to assign you a very super high investment grade. But what Jensen says, go to the capital markets, go to issue a bond to finance a positive net present value project because the investment banking firms and the investment industry is going to come in and evaluate Jim. They're going to evaluate me. And if they see that I have a country club membership and I'm going up and I'm playing golf and tennis and swimming every day and I'm not coming back to work, if they see that I have a limousine service and I'm taking the limousine to the Kiss concert, if I have a Learjet and they see that I'm taking that Learjet and going on a vacation out to California, well, they're going to reveal that information to the investing public. And the investing public is going to say, you know what, Jim, you ought to be fired. Or at least a minimum, we're going to charge you a higher interest rate. What's the goal of the business? Maximize shareholder wealth. How do we do this? Minimizing the weighted average cost of capital. So what Jensen does is Jensen suggests that the issuance of the bond is going to put me on my best behavior because I'm going to be heavily scrutinized by the investment banker and the investment consuming public in general. And that takes us through what admittedly is a relatively long recording. So I hope you're with me and I hope you had some value. I want you to go to those 5 questions at the end of this learning module. I think they're relatively straightforward based on what we have presented you in this recording. So go do that. I bet you can do it in 10 minutes. You need your calculator. You're going to have to do some calculations. So thanks for watching. Have a great day. Good luck studying.